Good morning, Jax. What's up, gang? How's it going?
Morning.
Hey, going good. How are you doing?
Doing great. 2 cups of coffee in me, so I'm ready to get going. Okay, so is today the day we're finally going to break out through 3,000 in the S&P? I guess time will tell. I'm sort of tired of keep talking about it, to be honest with you. If we're going to do it, might as well just do it. Get over the 200-day, get over the 3,000 major VOP resistance, and let's move on. Otherwise, if we're going to fail, let's just fail and then roll over. Everybody is looking at that, and there's not much more to add value to this logic anymore. So let's move on to specific stocks. So I have two things. One is a big theme that I'm noticing that is pretty obvious to some people, and then one specific stock I want to quickly discuss. The big theme is that, for our sake in Jaguar, the research that we do largely entails two parts, the fundamental research that is. All four of us love to dive into reading the earnings transcripts that comes out from companies, reading the actual commentary from the management about what they're saying about the outlook, as well as looking at the Q&A between analysts and the management. So that's one part of doing the fundamental research, and the second part is looking at the consensus view, the street reports that are out there, and looking at what they're saying about particularly forward-looking comments, including channel checks and such. And then based on all of that logic, then forming our own opinion to provide, what we think about the stock, whether it makes sense or not, bullish or bearish. So that's what we do at the core of our fundamental research in Jaguar. But one thing that we don't do as much of, but I personally like to do on a quarterly basis, there are a lot of money managers out there. I mean, these are the guys, these are not the sell side analysts, the street analysts that we look at all the time, but these are the buy side firms, small shops, as well as hedge funds and such, that on a quarterly basis, they make a lot of investments in various stocks or shuffle their portfolios. Not every one of them provide after their 13F filing comes out with the SEC. Not everyone provides a commentary, a written commentary to their investors about their outlook and talking about each of the positions they have in the portfolio and why. Some of them do, and the ones they do, that's the part that I love to read the most, especially the ones that are making highly concentrated bets, to understand why these people are putting money into various stocks and so on. So one of those companies that I like to take a look at is this one, Shaw Spring Partners. This is based in Boston, Massachusetts. And on May 15, they provided their quarterly outlook, a very nice long 28 pages long lending note discussing every single position that they have in the portfolio. This is a $500 million $500 million fund that makes highly concentrated bets. To give you an idea, this is the breakdown of their entire portfolio. Look at the top holding there. Sea Limited, 23% gross exposure in just that one stock. IAC Interactive, 20%, JD.com. I mean, all three of these are internet companies, right? So if we add just the top three here, that's 43, and then 68% of the portfolio is just in three companies, highly concentrated at all three internet companies, and it happens to be based in three different regions in the world as well. Sea Limited is Indonesia, Thailand, Singapore, Malaysia, all of that. Southeast Asia essentially. IAC Interactive Corp is the US, JD is China, and then Mercari is Tokyo, which is also internet. Square, we all know that that's also internet. ANG Home Services, which is part of Interactive Corp. Just Eat Takeaways, this is the food delivery business that's based in Europe, also internet. Carvana, also internet, and then cash balance is only 1%. So highly concentrated only in tech stocks, only in internet space. And so this breakdown makes sense. Now, why do I bring this up? Because there's a couple themes from their report that caught my attention. The first big thing they've talked about is really this chart. And I think it's worth mentioning what's happening during the shutdown period. Look closely at this e-commerce penetration in the United States. E-commerce penetration as a percentage of total sales in the United States has been gradually increasing for the past 10 years by an average rate of 1% per year. A very slow, nonetheless, a clean improvement and higher penetration. It took 10 years to increase penetration by 10%, and it took only 8 weeks to increase penetration by 11%. I mean, this is just phenomenal. This has just gone straight up in a hockey stick style lineup. Now, put this in context of what's really happening in Amazon. What's happening? What does this mean for Walmart? What does this mean for Target? Costco, because those are the big box retailers, and then you can add some other smaller companies as well that are taking so much significant amount of market share from the brick and mortars. And one thing I know from history is that once somebody is tapped into the e-commerce and started to do shopping online, they even if things go back to normal, the e-commerce or shopping online is so sticky with customers that they never actually return back to doing things the old ways. So what does this mean in the long run for Amazon? And naturally, it is very bullish. And we know Amazon has been attempting to break out again. Yesterday was another new 52-week high before backing off a little bit. And this chart looks absolutely amazing. It's not just in the US. If you go to China, you see same exact trend. Look at the sharp acceleration. Now, first of all, when I saw this chart, I was quite surprised that the e-commerce penetration in China was only 1.2% in the third quarter of 2019. And actually, it had been trending down, unlike the United States, which is always trending up. Nevertheless, but even in this case, this one just took off, rising to 3.4 and then 5.6% total penetration of the total retail sales. And what does this mean for JD, for Alibaba? We discussed Alibaba in webinar yesterday as well. And then same exact thing about Latin America. Latin America is no different. We talked about this also, and this plays in the hand of Mercado Libre. And here's a comment from Mercado Libre that caught my attention, in which they said that the region was at a point of no return with regards to e-commerce penetration, evident from its recent financial statements. I mean, get this, the Latin American lockdown in April resulted the currency neutral GMV growth that accelerated to 73% year over year, a sharp acceleration from just 3% trough that we saw prior to lockdown. Mid-March was 40% growth. Mid-March was 40% in the fourth quarter of 2019, and now it's 73%. So same thing is happening in Latin America as well. Now, putting this all together, Sea Limited is their biggest position, and we know Sea Limited, which has been our favorite ever since that stock traded at $30 per share, has been a huge rise. Well, same exact thing is happening there as well. These are different scenarios that are presented for just the Indonesian e-commerce penetration market, and depending on which scenario Sea Limited follows, you can see that if it follows the historical trend in Indonesia, then you can see that this thing is going to see penetration increase all the way to 23% in coming years, versus right now is in high single digits, like 7 to 8%. If it follows the Chinese inflection, then it could get even more accelerated penetration, rising to 26% in the US. If it's going to be much slower, but still a very strong trend, generally speaking. So when I put all of this together, there is a sea change, excuse me. When I look at all of this together, there's a sea change that is taking place in all of these. And I look at these numbers and I say to myself, I think pullbacks in some of these names will remain shallow. Amazon, Walmart, Sea Limited, Mercado Libre, and we can just go down the list. And so this is very, very positive for what's happening the longer the shutdown continues. By the way, talking about Mercado Libre, which is one of our favorite as well, Brazil just this morning recorded 17,000 new COVID-19 cases, a record daily high. That chart has been parabolically going higher. Naturally, all of that is very, very bullish for MELI. So that was one high level view. Second thing that I want to discuss is the Match, MTCH, which is owned by majority owned by IAC Interactive, although they have been trying to unload that position in order to diversify away a little bit. And this chart is potentially going to break out through $90 per share in my view in time. It's been attacking that level multiple times already. Is this the weekly chart that you're looking at yourself? And is this thing is possibly going to take a couple more weeks before it busts through higher? But as so strong as these markets are running, I think that could happen very soon as well. There's an interesting take on this one. What I'm noticing in the trends is that this is funny because logic would say that dating business, particularly online dating business, may have taken a back seat in the time when everything was shut down. It turns out, in terms of Match, that we have seen a sharp increase in the female under age 30 that are using Tinder for virtual dating. And the trend took off really starting from very late in March. It went from 0% growth in that particular segment of Tinder to all the way to more than 40%. It has settled back in a little bit at 30%, but I thought this chart over here to the right with female under age 30 getting on Tinder to find dates and whatnot I thought was very, very interesting. The high point of this, according to the latest reading, was about 37%. Now, considering males have historically outweighed females in the past, if this recent jump in female engagement results in a higher base level activity after the crisis, in my opinion, it will create an even stronger network for Tinder as well as Tinder Gold. So this is once again the sticky point of this business. If this happens, I think that investors will start to sniff this out. Earnings are already out of the way, and I think ultimately that will lead to a breakout in the stock through $90 per share and then possibly a run towards $100 per share. So I know a lot of words of wisdom over there, but I'm just looking at these patterns and combining them with fundamental views. So this one stands out for me. So that's it from me. Avo, you go next. What do you have on your watch list?
It's interesting about Match.com, isn't it? Because you think with the lockdowns or enforced stay at home, or suggested at least, this would be crashing, but it's not because people don't necessarily listen to it. That's very interesting. All right. I looked at Tetra Tech. It's a company that we haven't spoken about for a long, long time. TTEK is the ticker. It looks to be interesting chart to me. 8K, not C.
Oh, TTEK. Okay, I see.
Yeah.
All right.
It's a consulting engineering service. Now they have two segments. Well, two segments, two big segments, but there's some sub-segments as well. Obviously their commercial segment is not doing that well, and that accounts for about 25% of revenues and has the greatest negative exposure from lockdowns and whatnot. But 30% is federal, military included, 15% is state and local, and there's another 30% of overall exposure that is international, of which half is government as well. And they've already reported the earnings, as I said. It was so-so. It was in line. I think it was just a slight miss. Of course, I closed my page as we started talking about this. They actually increased their dividend a couple of cents. All right, so I reported 73 cents, and which was a couple of cents above consensus. And this was at the end of April. Now, this was up to March 29th, but on April 20th and 22nd, they got close to $300 million and a $90 million contract, so just under $400 million in contracts in April from the military. This doesn't take trade much options, just thought I'd throw that in there. Company still has a good balance sheet, 770 million liquidity, 99 million free cash flow in the quarter. Their backlog, $3 billion, just down quarter over quarter, just a little bit. Book to bill, or book to burn as they call it, a little lower than the previous quarter as well. But I think overall, this is something to just keep an eye on and see how it goes forward.
Two things. Sorry, go ahead. Finish.
Yeah, go on.
Two things that I would just say about this. First is the pure technical view. As you can see from my lines that I just drawn over here, that there's a confluence of resistances between $75 and $80 per share. Naturally, it will have some tough time clearing through all of this, particularly with this high volume sell-off that happened back on April 30th as well. And so a lot of so it needs to overcome a lot of those views before we could have a clear breakout. So in technically speaking, what I do in situations like this, if I find something that is down a lot but has potentially improving fundamental views, I simply draw those resistances and wait for triggers to go off. So in this case, if the trigger goes off above $80 per share, even if I'm overpaying at that point, it's a much easier bet to make at that time with a tight stop below the breakout level, and then basically ride the momentum. So that's the technical view. And the second thing is that, there is still a decent chance that Republicans and Democrats are going to come together with a third package or fourth package. I can't even remember how many packages that have been out there. Fifth, I guess. All right. Wow. So it's supposed to be another $3 trillion, but a lot of the things that are in it, that Democrats put in it when they passed it from the House, Republicans didn't like it, like so much money for states and blah, blah, blah. But according to just yesterday, there was some room for negotiation between the two parties, and they said, let's go back to the tables together and let's figure out how we can make it work for both of us. So I think that's going to happen over the course of next several weeks, and this stimulus package will possibly come out in July, and it'll probably be the last one before elections happen. In this package, there is some money for infrastructure, for construction, infrastructure, all of that. Who knows, that might be beneficial for a name like this, Tetra Tech, given 30% of its exposure to federal government.
And that's why I mentioned that, it's worth, not exactly for that, but technically that's why I mentioned that it's worth keeping an eye, because I did notice the downtrend. But more than that, it's if you look at the MACD, it's slightly crossed over bullish, and it's also above the 50-day as we speak. And I don't have statistics, but in my experience, or at least in my observation, the military is one area where you don't necessarily get layoffs, no matter what time it is.
Excellent. Jay, what do you have?
So today, I noticed in First Read that Stifel raised their price target on Everbridge to $160 from $130, based on a new product related to COVID-19 that they released yesterday, I believe. And then actually shortly thereafter, First Read came out. I saw that Needham is raising their target to a street high 175 from 135. And that was actually based on a CEO and CFO management call or meeting yesterday at their technology conference. I haven't had the chance to look at their notes yet, but I will, and I'll share them in chat a little bit later. But the other stock I wanted to talk about was Tabula Rasa, so TRHC. We've covered this name a few times before. This is a healthcare IT company that has a proprietary software that analyzes prescription drugs, and the goal is to reverse adverse drug events and hospitalizations. One area that it serves and is the biggest component of revenue is through their PACE program, which provides medical social services to the elderly. And they have their medication risk management technology that they offer there. Well, yesterday, data was out from the CMS where they published national enrollment data for the PACE program. And for the month of May, that data showed that the number increased by 8.5% to 49,428 members. And this is notable because when you go back to their conference call, management started to caution investors based on COVID-19. They felt that they were going to see some negative trends happen soon. Well, this 8.5% falls under the historical average between 8 and 10%. And Robert W. Baird was out saying they had thought that there would be a greater sequential deceleration in that number. So the fact that they came in at 8.5% is a positive and something to monitor going forward.
That's good. Really good take over there. I have to say, technically, this looks great, actually, as long as it holds that $54 to $55 VOP support levels. This is another pennant formation. A clean breakout. The way I read this chart, you can see that it was consolidating here in late March, early April, then a clean breakout on rising volume, followed by a new layer of consolidation, double bottom also around 54, and now it sets up for a breakout from the pennant. If it clears this, let's say about $61 per share or yesterday high essentially, then I could see this thing run all the way back to new 52-week highs. So another one to monitor with by setting simply an alert on the systems, above 61, and then let's see how it proceeds from there. Excellent. Chronicle, what's up?
Yeah, so this is a follow-up to what I touched on yesterday regarding commercial and office properties. So like the short side of the pair trade I'm working on. The problem with shorting commercial REITs is that at any given moment, the authorities could further loosen refinancing regulations, or Fannie Mae or Freddie Mac can announce further deferrals, and then these REITs will just continue to frustrate the bears again. So in terms of risk management, it's hard to tell how badly that short trade can go against us. Meanwhile, I was also looking at the office furniture suppliers, but a lot of them are small caps. Typically, I try to avoid shorting small caps, as they do carry a risk of spiking, say 10 to 20% on certain days. So instead, I've chosen to express my bearishness on commercial property by going straight to the liquidity source, which is the banks. If we look at the ratio chart of XLF to SPY, we can see the underperformance has been pretty bad. And it's even more jarring if we look at KRE/SPY. And beside net interest margins being squeezed, I think there are a couple other major reasons why the market hates banks right now. Firstly, I think the market knows that a lot of these banks simply have not set aside enough provisions for credit losses. Like if we take a look at this chart showing allowances for loan and lease losses, we can see this recent ramp is only just getting started. Things are worse now than they were back in 2010, and yet banks have set aside barely half of that 2010 level. Right now, it's really the bigger banks that, like JP Morgan and Citi, that have set aside significant portions. But it's the regional banks that I'm concerned about, because from the numbers I've seen, a lot of them are either being complacent or they're just trying to massage earnings for now. Granted, we do have idiosyncrasies today that didn't exist back in 2010, like low interest rates and a lot of liquidity. But I strongly believe provisions are still going to go higher from here, not lower, especially if a fifth fiscal package continues to get delayed. And secondly, there's just not enough visibility into the future when it comes to banks. Like banks don't typically provide any guidance at all. And at least with other industries, even if they don't provide guidance, there's still plenty of tangible indicators we can look at in order to extrapolate what numbers are going to be. But with banks, there's just not enough visibility. And I think that's another reason why the market dislikes them right now. So long story short, I've identified a short candidate, which is Bank OZK, symbol OZK. They are a regional bank that serves the southeast region of the US. This bank has $18 billion in total loans, with roughly 70% exposure to private commercial real estate, and they've only set aside $120 million in provisions. Meanwhile, their return on assets has gone down the drain from 1.99% to 20 basis points, and similarly, net interest margins are down 57 basis points. I think the situation will only get worse because I don't envision a scenario where we see lots of new offices and commercial properties getting built. So that's the short side of the pair trade I'm working on.
Okay, this is great. I'm looking forward to your full write-up on OZK. That'll be a fun read. I do want to mention that I completely agree with you regarding not having enough loan loss reserves on the books for a lot of these regional banks. For those who do not know, I did a podcast on another bank like this on April 23rd in BOKF, which is BOK Financial, that has huge exposure to the energy market. And same exact thing, I ran through the whole math step by step to show people that the bank was simply not reserving for enough loan losses. And I think there are a lot of other bad apples out there within the regional banking index, which has been actually underperforming quite a bit the whole market. So I think we're going to see more shoes to drop in this area. And I think we're going to find out when the second quarter earnings season begins how many banks will be forced to record much higher loan loss reserves than what they reported when the first quarter ended. So I agree with a lot of that take. So great stuff. Looking forward to your write-up on Bank of Ozark. OZK is the symbol, and there's a large pennant formation that is happening here as well. All right, guys, this is a little bit longer than the ones that we have been doing, but so much great content to cover. Thank you very much, and I will see you in the chat room shortly.